The pressures that were present a few years ago when we last had high commodity prices, the stresses and strains, the restrictions have returned. So a lack of skilled labour, you could be paying $150,000 a year now for somebody in Australia to drive a big truck around. Commodity prices have gone up. Supply is trying to react to higher prices and higher margins, but the same pressures are returning in terms of labour availability, equipment availability, lead times for environmental permitting and the like. But each commodity is different. So in the case of copper, the existing big copper mines like Escondida, like Grasberg, which is owned by Freeport in Indonesia, Chuquicamata, owned by Codelco in Chile, they're all having to spend a lot of money just to maintain production. So we won't see an increase in supply even though there are higher prices. So we're very positive on copper. Similarly for iron ore, there are logistical problems in terms of building the railway capacity and the port capacity and the power capacity that's needed. So the reaction of the industry to higher iron ore prices is going to take some time. When we talk about mining stocks or mining companies, these are sometimes also called extractive industries, but these are the companies that are digging the commodities out of the ground. So they're going out there exploring for it and then building an open pit mine or an underground mine, plus all the processing facilities, the environmental work that needs to be done to take that raw ore, copper-bearing ore, and produce copper, or the final product, which is then sold on the international markets and then further manufactured into bits for cars or hairdryers. Our approach and our whole investment philosophy is that we believe that you need to invest at all stages of a company's development, and that for companies that can grow, because let's not forget these are finite assets, if you have one mine, at some point that mine will become exhausted. So we need to find companies that can replace and find new discoveries to replace the production of their current operations and that can grow their resources and grow their production. And if we can identify those types of companies, then we believe we can outperform. If we go on to valuations, what's the market trying to tell us? What they've got in their forecasts are iron ore prices to fall 2/3, from, let's say, $180 a tonne to $70 a tonne iron ore. Copper prices falling from well over $4 a pound to $2, or I've seen some estimates of $1.75 a pound longer term. And we just don't see that. Look at Rio Tinto, reported some great numbers a few weeks ago. The market's pricing in the best has passed. And again, we just see prices stronger for longer. And the whole sector has, been on multiples that are far too low. So in general, the consensus is too pessimistic. The sector as a whole is volatile. A lot of that we ascribe to the fact that investors tend to rent investments in this sector rather than own them. They're always scared that the Chinese growth might be slowing or there's some other shock coming along, so they typically will invest on a 6 to 9 month horizon. We invest on 3 to 5 year horizons. We're buy and hold, which you need to be because the sector is volatile, but we do take a long view. I think with gold it's very important to always keep an open mind because it's the one commodity or currency financial asset that is not driven by supply demand. It can support the price, but gold price peaks are driven by investors. They buy more gold, they buy gold ETFs, exchange traded funds, the price goes up, they buy more. It becomes a virtuous circle. If the price starts to drift down, it can become a vicious circle. But it's important to always keep an open mind and naturally appreciate what is going on in the world. So, but we still come back to the fact that We are investors in gold mining companies, not gold bullion itself. So that still comes back to the fact that we're looking to companies to be able to grow their production and explore and find more gold deposits based on a flat outlook for the gold price.